Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Digital Turbine Inc. quarterly report. Digital Turbine Inc. offers a wide range of businesses and services through its mobile growth platform. The company's primary focus is on delivering mobile applications to various publishers, carriers, OEMs, and devices through its application media platform. This includes content media platforms that provide news, weather, sports, and other content, as well as programmatic advertising partner and media content delivery services. In addition to these services, Digital Turbine also provides direct campaign management products, such as the DT DSP and DT Offer Wall. These solutions enable mobile app publishers and developers to monetize their monthly active users through display, native, and video advertising. The company's ad monetization solutions cater to various clients, including brands and agencies that run mobile brand awareness campaigns on direct mobile app inventory. Digital Turbine also offers services for app developers and performance-focused advertisers who execute mobile user acquisition campaigns for their apps and products. These services are used in the mobile application ecosystem to enable brand discovery and advertising, user acquisition and engagement, and operational efficiency for advertisers. With a global presence spanning multiple regions including the United States, Canada, Europe, Asia-Pacific, China, Mexico, Central America, and South America, Digital Turbine's services cater to a diverse range of clients worldwide. The company's businesses and services can be summarized into several key areas: application media platform, content media platforms, direct campaign management products, DT DSP and DT Offer Wall, ad monetization solutions for mobile app publishers and developer services for brands and agencies, running mobile brand awareness campaign solutions for app developers and performance-focused advertisers, executing mobile user acquisition campaigns. The stock price of Digital Turbine, Inc., APPS, has skyrocketed over 94.49% in the past year due to a combination of strong financial performances, strategic partnerships, and operational advancements. One key driver of this surge is the company's exceptional quarterly earnings reports, which have consistently surpassed analyst expectations. In November 2025, Digital Turbine reported fiscal Q1 2026 earnings that exceeded forecasts by a significant margin, leading to a 21.62% jump in after-hours trading. The company also raised its full-year guidance at this time, citing double-digit growth in revenue and EBITDA. In addition to strong financial performances, Digital Turbine has made strategic partnerships with major players in the industry. In January 2025, the company announced a partnership with TIM Brasil aimed at enhancing smartphone experiences for millions of customers. This was followed by a partnership with Alcatel in June 2025, which is expected to revolutionize mobile user experiences in India. The company's operational improvements have also contributed to its success. Digital Turbine has accelerated growth in its on-device solutions, ODS, business, which saw an 80% year-over-year increase in Q1 FY26 and now accounts for over 25% of ODS revenues. The company's strategic focus on integrating AI and machine learning into its operations has also yielded positive results. Overall, Digital Turbine's stock price surge can be attributed to a combination of strong financial performances, strategic partnerships, and operational advancements. As the company continues to expand its international presence and capitalize on regulatory shifts in the mobile ecosystem, investors are likely to remain optimistic about its future prospects. Digital Turbine, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Digital Turbine, Inc. trades at a higher price-to-book ratio of 3.4 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On one hand, revenue growth is primarily driven by mobile content and commerce revenue, digital media revenue, and significant increases in net revenue over the past year. The ODS segment has seen substantial growth, with an increase of 219.1% for 9 months, while the AGP segment has also experienced notable growth, with a 19% increase for 3 months. In addition to these trends, the company's ability to exceed annual revenue targets by more than 150% in certain areas is a significant contributor to its revenue growth. Furthermore, an increase in billed accounts receivable and strong performance from various segments have also contributed to the overall revenue growth. On the other hand, revenue decline is primarily driven by global economic slowdown, decrease in mobile phone sales volume due to inflation and economic uncertainty, and macroeconomic trends impacting clients' businesses and consumer confidence. These factors have led to a decline in demand for goods and services, resulting in a negative impact on revenue. The net income of a company has shown significant improvement over the past year. In Q3 2024, the company suffered a loss of $23,131, but by Q3 2025, this had turned into a profit of $5,107. The year-to-date YTD net income also showed a substantial increase from -$73,273 in YTD 2024 to -$30,392 in YTD 2025. The change in net income can be attributed to the significant improvement in operating income margin. In Q3 2025, the operating income margin rose to 5.6%, up from -9.4% in Q3 2024. This indicates that the company has been able to manage its costs more effectively and generate higher revenue. However, it's worth noting that the effective tax rate for the period is not directly reported. The only available data shows a negative effective tax rate of -9.3% for the 9 months ended Dec 31, 2025. This suggests that the company may have benefited from tax credits or other tax-related adjustments. Overall, the improvement in net income and profit margins can be attributed to the company's ability to manage its costs and generate higher revenue. However, further analysis is needed to understand the underlying factors driving these changes. The company is indeed generating positive operating cash flow. This is evident from the financial data presented on page 47 of the report. Specifically, the net cash provided by operating activities for the 9 months ended December 31, 2025, stands at a substantial $37,424. This figure represents a significant increase of $37,052 compared to the same period last year. This upward trend in operating cash flow is a positive indicator of the company's financial health and ability to generate sufficient funds from its core operations. The strong growth in operating cash flow suggests that the company is efficiently managing its resources and generating profits from its business activities. The company's debt level and interest expenses have undergone significant changes over the past year. While total liabilities have increased by a relatively small margin of $4,677, long-term debt has decreased substantially from $408,687 to $350,280. This reduction in long-term debt is a positive development for the company. However, the introduction of short-term debt with a net value of $4,688 suggests that the company may be taking on more debt in the short term. On the interest expenses front, there are mixed signals. Interest expense, net decreased by $9,225 in 2025 compared to 2024, but increased by $9,221 in the 9 months ended December 31, 2025, compared to 2024. Furthermore, amortization of debt discount and issuance costs increased significantly in both the 3 and 9 months ended December 31, 2025, compared to 2024. This increase suggests that the company is paying more to service its debt. On a positive note, interest paid has increased from $27,597 in 2024 to $36,027 in 2025, indicating that the company is taking on more debt but also paying more interest on it. Overall, while there are some mixed signals, the data suggests that the company's debt level and interest expenses have changed significantly over the past year. The performance of various segments and regions has been a mixed bag in the recent quarter. On the positive side, the ODS segment saw a significant increase in profit, rising by 34% to $86,974 within just 3 months. This impressive growth is a testament to the segment's efficiency and effectiveness. In contrast, the AGP segment struggled, experiencing a decline in income from operations for the period. Despite this setback, the consolidated segment showed resilience, with a notable 25% increase in profit to $237,046 over 9 months. Geographically, some regions fared better than others. The United States and Canada witnessed an uptick in long-lived assets, with a 13% increase. However, Europe, Middle East, and Africa saw a substantial decline of 50%, while Asia-Pacific and China experienced a decrease of 24%. These regional disparities highlight the need for targeted strategies to address specific challenges and capitalize on opportunities. Management is expressing a cautious outlook for the company's business. Despite plans to expand its alternative app market through acquisitions, they acknowledge that declining sales of new mobile devices by partners will continue to impact their business due to inflation and economic uncertainty. The company is facing financial challenges, including potential material adverse impacts on its business, financial condition, and results of operations if it cannot refinance certain loan tranches or raise additional capital. Management has expressed concerns about the availability of sufficient cash flow from operations or future borrowings/capital markets to pay debt and fund liquidity needs. Overall, management statements suggest a focus on navigating short-term financial challenges while exploring opportunities for growth through strategic acquisitions. However, they are also emphasizing the need for caution in light of ongoing economic uncertainty and its potential impact on consumer behavior. That concludes the financial summary for Digital Turbine, Inc. Feel free to comment below, and I will be happy to answer them when possible.